Welcome to Tab's Two Cents, a show for average Joe investors where we talk finance and how to achieve success.
Simon, welcome to the show.
Hey, thanks for having me, Joe.
Yeah, no worries. So I wanted to get you on. I've been following you on Twitter and you sent out some pretty informative tweets. And just from our discussions about the show, you've mentioned that you've been investing for 15 years, which is a lot longer than me. I've been doing about 5 years now. And you also say that you have a background in engineering. So I wonder if you could just explain how you started investing, what your process was like in the beginning, and where that's brought you to now.
Yeah, for sure. Where I started in investing in stocks primarily when I was fairly young, probably not that different than a lot of other people. Very naive, just looking to make some money and didn't really know what I was doing. Hopefully, I've gotten a little bit wiser since then. I've made my fair share of mistakes, obviously, along the way, and still trying to really learn a lot. The one kind of nice thing about investing is that you can really spend your whole life and continue learning till the end, right? So that's kind of the passion that kind of keeps me going, is that the learning never really stops, and it's always evolving. So I started out by trying to pick stocks, just like lots of other people out there, not really knowing what I was doing. Just kind of selecting what I thought would be a kind of good companies based on probably very oversimplified valuations, price to earnings multiples, by cheap things. Think that I have some kind of special knowledge. Generally not the case. Sometimes you get lucky, sometimes you don't. Would fall into a lot of the same pitfalls that new investors fall into, not really understanding the difference between investing and trading, for instance. So trying to make a quick buck by trading in and out of all kinds of different stocks, not really understanding the risk that we're taking on if you're doing that kind of thing. The good part about doing it when you're young is that you're doing it with like a few $100, right? So yeah, in the grand scheme of things, it may seem like a big deal at the time, but all your mistakes you make when you're just starting out, hopefully you make a lot of mistakes, and hopefully you make them early, and the goal being to kind of learn from them. So I was fortunate that I started out fairly young. It was always kind of an interest of mine, kind of since high school, I suppose. Growing up, I grew up on in a very small town in rural Canada, and on a farm. And so with a farm background, it's kind of a good example of what a bad business might be. Obviously, it's a small farm is a challenging business to really make it go these days. And it shows you, the challenges with like such a capital intensive type of business. So I think that background actually helped me a lot to understand really some basic things like the value of hard work, and I know all those kind of classic tropes of growing up on a farm are true. And I really valued getting an education from there. So always liked, the math and sciences. So engineering was a natural kind of fit, and got a degree in chemical engineering. Moved out to Ontario for work, and I'm still out here. Met my wife out here, and still working in the same field. But investing's always been kind of a side hobby of mine. I like to think that I've really kind of matured in terms of how I look at investing. So gotten away from the quick kind of trading speculation side of things, and actually buckle down a little bit more and try to think about more long term. And then one of the things that got me into writing this Substack and going on Twitter is really about learning from other people, but then also like writing down my ideas. Like one of the great things about having like a journal or something else, like a blog or something like that, is that it forces you to really write down your ideas, and if you want to treat them as like a thesis or a pitch, for an idea, then it forces you to have to explain it, right? So if you have to explain something and teach it to someone else, let's say, you need to be sure that you have some idea about what you're talking about. And if you all you have to do is click, a buy button about your idea that's in your head, and you haven't really written it out, you're likely to not necessarily have a really good understanding of what you're buying. And if you don't have a good understanding of what you're buying, then you're very likely to not be able to decide to hold on to it when you should, and maybe you sell when you shouldn't, kind of thing, right? So that's kind of the background in terms of how I got to where I am. We could talk a little bit more about like my investing philosophy if you'd like after, but that's kind of the context for how I started. And hopefully I've evolved, and like over the next, let's say 50 years, if I can make it that long, then I'll keep evolving. That's really the long-term goal, is to not stay still in terms of how I think or how I look at things, right? So I think that helps with keeping me going with investing. Is it's not something that's written in stone.
Yeah, for sure. And I think that for one thing, there's a lot to be said about having a blog, and I'm in the same boat. One of the great things about the internet is that, and this has happened to me a couple times already, if you post an article, people will read it, and there's always somebody who's going to find something with your article that could be wrong.
Yeah.
And I'm completely open to that. I would like to hear those criticisms.
Yeah.
And it's almost like you use it as a peer review when you post it out there, because you know that if you make a mistake, people are going to point that out. That's just the way the internet is.
Yeah.
But I love that. Like, I want that.
Twitter is great for that, for sure. Yeah.
Yeah. Like for me, the criticisms are in some ways kind of like in a golden egg of the internet, because you can learn from those. And, but also I think that you make a good point investing when you're young and that you don't have that much money. But also I think if you're older with lots of money, it's a good idea to use small amounts of real money.
Yeah.
Because I know for me, like, I didn't really learn any lessons with a paper account.
No, it's
not the same.
If
so I
people
have
are
to
asking
agree
me,
there.
yeah, people do, I don't know about you, but people sometimes do kind of ask me for like, hey, how do I get started and things like that, when they hear I've been doing it for a little while. And to be honest, like, the answer is you gotta actually do it. There's a lot of good books out there, and there's a lot of good like advice that you can go online to get. There's also really a lot of bad advice too, so you gotta comb through a lot of the stuff to get to the good stuff. But and I don't like, you gotta have your own skin in the game, right? So the idea that like you can outsource conviction. So like one of the things that takes a long time to learn is that like you shouldn't be buying something unless you have your own conviction. You have to have conviction in what you're buying. You can't just buy like a SPY, S&P 500 or a NASDAQ index fund, or an ETF, let's say, exchange traded fund. That's always the common advice to people, is, oh, well, just go buy an index fund. And like, that advice is good, but it has to come with, hey, by the way, like, you need to be comfortable with this thing tanking by 50% tomorrow, because that is in the realm of possibilities. If you think about the world probabilistically, which you don't need to be an advanced, math person to understand what that means exactly, but like, what you need to know is the reality is you don't have any control over what the stock market's going to feel like tomorrow. It's one thing to say in advance, oh yeah, I'd be comfortable holding through a crash, but unless you've lived through one, like, you don't know. Your brain is not wired to think about that ahead of time. You have to have your own conviction that you understand what you own, and you understand that it's a real possibility that some of this money could go away very quickly. On paper, like, unless you sell, then you realize the loss. But people tend to sell when they are bleak and there's despair in the air.
Yeah, for sure. And I think that you get some of those feelings even with smaller amounts. One thing I wanted to ask you about is, what were the lessons that you've learned that brought you to value, and why do you think that you've held on to that style of investing?
Yeah, I don't know that I've fully held on to like a value style. I think part of me, maybe it's like the rational engineer training that sees like the intellectual appeal of traditional value mindset. Like it's a little more mathematical in terms of like, here's, a quantitative set of numbers that says like, by the way, this is like a relatively good value. But the more I've evolved, I started out by being like, oh yeah, I need to buy cheap stocks. That's the way. And what's a cheap stock? Well, it must be something that's relatively low price to earnings, because that's a metric that should tell you that you're buying a relatively, cheap stock compared to something that has a high price to earnings or a high price to sales or whatever metric you'd like to use. But the reality is like businesses aren't measured by one number. And I've kind of evolved. It's taken a long time. I wish I've learned this kind of faster, but such is the way, I guess, with a stubborn mind like mine. So yeah, over time, I think I've evolved to be a little more fluid in how I think about valuation, like valuation being kind of how you value the current business, right? So if you think about value as like the current price you pay for all the future cash flows that could be sent back to you as a shareholder in that business, then there's a lot more to consider. Most of the value is in the future. And a price to earnings ratio as a classic kind of value measure is really only measuring something that, typically it's a measure of last year's business performance, right? The last year's earnings. And so, if you look at like cyclical industries, their earnings are all over the map. Whereas there's other types of businesses that are a little bit more predictable and less reliant on things like oil prices or something like that, right? Like a commodity price. That not all businesses are created equal, I guess is what I'm getting to. And so that's forced me to, thankfully, it's forced me to kind of reevaluate how I think about value. The traditional value kind of metrics that people have used, they've been very successful over the last 100 years in terms of applying those. But the market's kind of evolved, I believe, over the last little while. Like used to be businesses relied on having tangible assets that could be, a railroad is worth this much because it costs this much to build the tracks and all the hard assets that go with it. And so that's where the value was. And these days, with the internet and software companies and other more capital light businesses, like the value is not in the kind of hard assets that show up on the balance sheet. Thankfully, I've kind of opened my mind to the fact that there could be value in other places. I do think that like there is a price to be paid that's too much for, a flashy tech name that promises 300% growth for the next 20 years, which may or may not happen, right? So perhaps we've swung the pendulum too far. Who's to know? That's one of those things where you got to find really what you're comfortable with knowing, and like that's the circle of competence that Buffett and all those old guys talk about. Like they kind of weren't too far off when they were talking about that stuff, because like if you understand technology, then you'll probably have an okay you might have an edge in understanding that like, yeah, this technology company that's promising all these future growth rates, maybe there's a pretty good chance they do it. Someone like me who doesn't necessarily have a great understanding of like these more complicated technology names, I just kind of say no, right? So it's not that I don't think there's money to be made there, it's just won't be made by me. So I still have like a value tilt. Like I wouldn't say that I have any hard, like I can't pay over a price to earnings of 40. I'm not gonna put those types of constraints on myself, but I do feel more comfortable not paying up for promised future growth beyond a certain extent. So yeah, hopefully that makes sense. That was kind of a long-winded rant, but I try not to I would still consider myself a value investor because like if you think about what value really is in terms of the future cash, like what you pay now is one part of it, and that's like the traditional value types of metrics. You know, you're paying on a cheap relative multiple based on past performance, and you're looking and saying, well, the market maybe doesn't appreciate this business right now. Mean reversion, so like the business will probably come back to like a normal multiple. So there's some multiple appreciation there, and the business may hopefully will continue to perform. So that's where you get your return from. And then the other part is there is going to be future growth. So you look for those businesses as well. Ideally, you find, you know, a great business that's got a very sustainable moat, so like a competitive advantage, and one that lasts a long time. So if you look at like a Coke is kind of a classic example, right? Like they make sugar water and they've been doing it for 100 years, and they're able to charge a little bit more every year, and they're able to sell a little bit more every year. So like that's a great business. So if you can find something like that and pay a really cheap price, that's kind of like your dual engine is kind of kicking in, and you'll get that's where you make a lot of money, right? It's not the way to get rich quick, I guess, but I've been burned too many times trying to get rich quick, so kind of given up on those ideas.
Yeah, no kidding.
Yeah.
Yeah, it's interesting that you say, you know, stay within your circle of competence, because I really believe that. I think that if you're somebody who specializes in something, there's going to be an investment opportunity in the market. If you look enough, you can probably find something that fits your, you know, your
exactly.
area of specialty. So that's interesting, because I feel the same way, and I've mentioned that to lots of people. I just say, well, what do you know, what are you good at? And then what's your hobby? Is it woodworking? What tools do you use? Is there a new one that just came out that, you know, perhaps is going to overtake something else? And, you know, there's always an opportunity there. And I think that it's interesting that you've kind of gone that same way as well.
Yeah. Like you gotta kind of, I think a big part of investing is like, you know, over time, you got to know yourself, and it takes a long time for people to kind of dig down into who they really are. It's not something like a 15-year-old, generally speaking, doesn't really know who they are. They're just trying to be the popular kid or whatever. For better or worse.
Yeah, and for sure, and it's not just, you know, your circle of competence, but also how your psychology is going to handle certain things.
Yeah.
Maybe it's better if it's all automated and you don't see the money and you just don't look at it. And then when you retire in 30 years in an index fund, you've got an extra $1 million. That can be better for some people. Other people like to be more hands-on. Obviously, you and I are more DIY, do-it-yourself style investors.
Yeah, I tend to just have a passion for like, I think part of it is just trying to analyze and like figure out, okay, like I get to look at, there's infinite number of businesses to really dig into, especially as like a personal investor. I don't have these mandates, you know, I'm not running a fund, and you know, a lot of these professionals have all these constraints around what they can look at and you know, what they can offer their clients. And I don't have any of those constraints. I can go and look at like a $200,000 microcap and put as much money as I want into that. Like that's not something that most, you know, so that there are advantages. I do think like stocks for most people probably don't make any sense. Like I mean individual stocks, right? Like they should talk to like their financial advisor, obviously, but for the vast majority of people, they don't have the time or the passion to like dig into individual companies and analyze them and build conviction and do all these things. Like so it's just that from that perspective, like individual stocks don't really make sense for most individuals. But that's just my opinion. So, but for those who get, there's so many good resources out there, and access to information is just so easy now that it's a great time to be someone who likes to pick stocks.
Yeah, for sure. I agree. I think that it takes a certain passion to really get the conviction. But if you're one of those people that that love it, then there's no reason you can't pick individual stocks. It doesn't
Yeah.
have to be index all the time.
Yeah, exactly.
Yeah, just talking about individual stocks, I've noticed that in your tweets you like to talk about Facebook or Constellation Software, and you actually wrote a blog on serial acquirers, which is obviously Constellation Software's business model.
I think so. Talking about Facebook briefly, I think there's lots of other kind of more experts out there on Facebook. It's a small position for me, but the thesis behind Facebook for me is, you've got this dominant player in this industry that's like crazy asset light, right? It's just prints cash. It's basically the world advertiser at this point. And the benefit is it's got this network that can be essentially it's global. So there's not really any limitations there. And it's run by this fanatic founder, Zuckerberg, who's love him or hate him or whatever. He's a robot, and he he will treat Facebook and all the the other holdings. Instagram is an amazing business. It's his baby, right? So like Facebook is not, the chance of Facebook being like a zero in terms of like somehow going bankrupt or something is non-existent in my opinion. Now, will competition come and like destroy it? Like maybe, but like, do you want to sign up for more social networks that replace what Facebook does? Like, I kind of doubt it. Like people hate on Facebook, but it's kind of like McDonald's, right? Like people don't like to admit that they use McDonald's, but they've sold 18 billion hamburgers. So it's hard to deny that a lot of people eat at McDonald's, and it's kind of hard to deny that a lot of people use Facebook. Anecdotally, people will say, "Oh, Facebook, that's no good," but then they'll, in the same breath, they'll go on about how great Instagram is. So it's the same. So they've got a bright future ahead of them. And when I bought into them, especially like even on traditional value metrics, it wasn't very expensive. It was like a market type multiple, like PE of 25 or something, which maybe back in the day that was a little bit pricey, but these days with these asset like companies, and I can't see how that's like gonna ruin me. It's probably not gonna make me rich either. So it's one of those things where it checked a lot of the boxes in terms of having a great management team, pretty good chance of future growth, lots of optionality. Like they're going after the metaverse stuff. I don't really have any insight into the metaverse thing, but to me that's like a free option. If they didn't have any metaverse plans, I'd be happy with all the cash they print. So so that's the kind of the thesis there. I haven't really written in any detail on Facebook, but that's probably where it starts, is the management team and kind of the moat they have around the social networks. And they also have they have a WhatsApp, which they have not monetized at all. So if they figure out some kind of strategy there, or if they just use it as a funnel to other businesses that then make money, that's fine with me. So anyway, that's kind of the thesis around Facebook. Constellation, I've written a little bit more about it. Like the thesis around Constellation Software, essentially it's got this amazing capital allocator with the founder, Mark Leonard, who looks like one of the singers from ZZ Top. I like to put his picture in anything I write because it's just amazing. So this guy has been doing it for the last 20 years, and he really understands he understands how to do acquisitions. He understands capital allocation. So basically, like capital allocation, you can think of as one of the main jobs of a CEO of a company. So I like to say there's there's 4 or 5 kind of levers a CEO can pull to do things with the cash that the business produces after it's, makes its widget or whatever the business does operationally. It has a profit. So then the CEO says, okay, I have this money. What do I need to do with it now? And ideally, it redeploys it at high rates of return so that the investors can grow their future cash flows. So with Constellation, they basically started out by a really small company, had a little bit of private investment, then became listed publicly, but since then haven't diluted shareholders at all. So started out with a tiny amount of capital. It's a fairly small company. Started out with like 3 or 4 little vertical market software businesses. And then they've really just grown by buying more of the same types of businesses all over the world. And today there's something like a $40 billion market cap. They really don't need external funding. So they're little businesses that they buy. They just kind of leave them alone for the most part. They don't get involved with telling them how to run their business. So they generally will buy like little small vertical market software businesses that serve a kind of a critical niche in a little industry. And the reason why these are great little businesses is that they have super high margins. They're software businesses. They don't really require any extra capital to get put into them. In most cases, they don't have a ton of organic growth. So the businesses themselves will just, the profits will just kind of go up with GDP nominally, but they'll just reinvest that cash into buying more of these little software businesses. And they keep the whole structure decentralized, meaning that they don't have like corporate HR and they don't have corporate finance teams and stuff kind of putting their fingers and telling them how to do their business. They just make the big capital decisions with the money. So kind of like a holding company that way. And anyway, the CEO, Mark Leonard there, he's really developed a culture that has aligned all these managers of these smaller businesses to do what he did originally. So like these days, he's not really doing any of those, little acquisitions of these $4, $5, $10 million businesses. He has his managers do that. He's kind of taught them how to do that. They share kind of best practices amongst the different groups. But even though it's grown to be this big thing, like the headquarter operations, they don't really get involved in the day-to-day business of all these little groups. So the whole strategy there is just to keep redeploying this money into these kind of boring software businesses that they're so small for the most part. They're starting to get into bigger ones, but for a long time they just stuck to buying little small businesses with the cash that they generated, and it's managed to get them like 100 times the original stock price, or a little bit more at this point. I don't know what it is now. I wish I'd bought them earlier. That's the only thing. So like the bear case on Constellation has been, the bear case meaning like what people are negatively kind of predicting about it, is that they're going to run out of things to buy. Because as you can imagine, to keep up like this growth rate, like I don't know the exact numbers offhand, but they managed to grow like let's call it cash flow, something like 25% or something like that a year. Margins of, the margins on the business have gotten a little bit better over time as well. But the bear thesis on it, so the bad things people are saying, is that they're getting so big that they're just kind of running out of target acquisitions. And so it certainly is a challenge to, in the first few years, they'd have to buy like a handful of businesses, right? And they could find that no problem. These days they have to deploy so much more capital. I don't know how much they spent last year, but let's say it's $1 billion. It's a lot more difficult to do that compared to having to spend $10 million. That's the bear case. The reality is like they have a tremendous worldwide kind of bank of potential targets to buy. So I don't really think that that plays out just yet. I'm not suggesting it's another 100-bagger from here. That would be kind of maybe outrageous to say, but but I don't think that it just dwindles either. So, and recently, another good thing about like Mark Leonard, he's kind of come out and said that, traditionally they had these high hurdle rates for what they would consider in terms of acquisitions, and hurdle rate meaning like a potential return that they could get off their investment. And he's always kept it very high, and it's served him well. At this point, because he's gotten so much cash coming in the door, he's actually said that, like, traditionally they would pay out a dividend if they had a lot of extra cash sitting around and nowhere to put it, which is fine. Like, that's one of the other kind of capital allocation levers a CEO can pull, right? Is they can buy back stock, they can pay back dividends to shareholders. Dividends to shareholders is traditionally thought of as like the last resort, because it's not really giving you a return that's going to be compounded, right? Like, you're going to pay tax on it as the shareholder, assuming it's outside a protected kind of account, and then you're going to have to do the compounding yourself by buying something else. So in that way, usually the least preferred. That being said, that's what they would do if they had leftover cash. So he's actually been convinced that maybe that's not the right thing to do with the extra cash. Maybe the right thing to do is lower the hurdle rate a little bit and try to go after some bigger acquisitions. So just last year, I believe that's what they came out with guidance and saying, well, we're going to revisit the dividend policy, and we're going to actually try to go after some slightly bigger acquisitions. And for those bigger ones, we're going to lower our hurdle rate so that we can find acquisition targets. So to some people that might sound bad that he's lowering the hurdle rate kind of return target, but in reality, if he can, put that cash to work and get a 15% return or even a 10% return, I have a lot more confidence in their ability to do that than I have in me finding something that gives a 10% return, right? So, and it doesn't get taxed. I don't have to pay tax on that either, versus the dividend. So anyway, that's an interesting kind of strategy, and only time will tell how that turns out. We'll see, but I think there's still a fairly long runway for growth there. It's an interesting one because I think I would never have bought Constellation like a few years ago, being like a traditional value investor. If you look at a lot of those metrics on Constellation, they would make, a traditional value investor kind of just immediately say no. So because I've kind of opened my eyes to the fact that if you have like 20 years of growth at 20%, then a 50 or 60 PE is not expensive. For instance, I'm just making up numbers, but versus when I was, a little bit younger, I would have just said, no way, I don't even want to look at it, kind of thing.
Yeah, for sure. And from what I understand, they acquire niche software markets.
Yeah.
So like specific software in very small markets. But as you say, as those companies and software providers start to get snatched up, then they need to move into bigger companies, and there's not that many of them available that are still really good. So I can understand why he's lowered his hurdle rate, as you say, to, I'm sure they can still find some good ones, but for the most part, it's a lot more competitive to acquire those bigger companies. So there is a bear case there for sure, but I like the business strategy. Also think it's interesting that both of those companies we brought up are both founder led, because I think there's a lot to be said for a company that's founder led. One of my stocks that I follow, Shopify, and they also have a founder led company, which I think bodes well for them, because for them, as you say, with Zuckerberg, Facebook's his baby. So these guys are going to put in the work. They're not just there for a paycheck.
Yeah, I always would prefer like a founder or someone with really like a lot of skin in the game of their own capital too, right? So even an outside manager, they can be really good, but it's harder to find an outside manager that really treats the company like a founder would. And a lot of times these outside managers that they hire, like, they're very, their incentives are just different. and you can try to incentivize them, but you can't change who they are. And a lot of times the incentives will be like, well, we'll incentivize them to get, the stock price up or some kind of metric which we think is aligned with shareholders' interests, and then we'll reward them with stock options. So we'll basically here take some stock at this cheap price if you hit these targets, which in theory like sounds good. But what's even better is if, say, like, hey, you have your own hard-earned money that you earned yourself, and you put that in, you buy your own shares. And that's, if you think about that, think about how you would, think about the stock, if it was your own money versus if it was something that was kind of given to you based on performance. Like, it shouldn't really make a difference, but it definitely does. So those small things really change how a management team, on average, is gonna think about the company. Now, I don't like, that's not the founder thing is not like something that I would just automatically say no if it's not a founder, but it's a great, like, positive thing generally. There's like some other, with smaller businesses, there's other factors that you have to think about. Like, there's some small cap companies that that it's publicly listed and the CEO kind of controls it. They're the founder, but they just treat it like their piggy bank and they give themselves a big salary. So you got to kind of watch for different types of things with smaller businesses. So that's a whole different conversation, but it's interesting. But I haven't had as much time to really like dig into the micro cap kind of space, but I think if I had more time, I'd love to dig into that area a little bit more. It's just, it takes a little bit more time and effort.
Yeah, for sure. I agree. I think that there are pros and cons. You have to have the right founder.
Yeah.
But it's interesting, like with someone like Zuckerberg, like he doesn't need the money.
Right.
So he's doing it for a passion for his business. For whatever reason, he just likes building Facebook and getting it as big as he can. Yeah. And he's not going to stop working. That's just what he loves to do.
I mean,
he could quit today.
He's like 35 or something, right?
Yeah. He'd never have to work another day in his life if he quit.
That's right. He could have quit a long time ago.
Yeah. So, I always find that interesting when there's guys that run a company that big that are the founders, and Shopify's the same. And it's like, those guys, they could quit any day, but they just keep on trucking because they love it. So, So just one more, I got one more question for you, and I think we can wrap it up. You put out a tweet I saw, and it said that you had to adjust your portfolio for whatever reason. I think you said I'm not sure if it was market conditions or what, but you just decided to rebalance it completely over.
I think I know what you're
completely reset your portfolio and start from scratch. And I just wonder what brought you to that point, and what did you change?
Yeah, I think so. I believe that was like essentially the COVID kind of March 2020, I guess, was it? Yeah, crash or whatever, call it whatever you want. Around then, I was still kind of, I had some businesses that were just, I didn't know them well enough. I was simplifying things too much, and I wasn't really focusing on like business quality in terms of like, does it have a durable moat? Does it have some kind of advantage, and can it survive these kind of crisis situations? And so I think during that, it was a relatively short period, like a few months, I guess, between kind of peak to trough. I don't know the exact timing, but yeah, like my portfolio was down just like everyone else's, I'm assuming, at that time, and it was really good that fortunately I had enough time and to really think about things, and it forced me to reevaluate kind of how I made decisions. So yeah, I think at that time I was still leaning too much to like the traditional oversimplification of like buying cheap things and you know, oh, it's up 50%. Oh, I should probably sell type of scenario. Not really thinking long term. And then when all this happened, and really it was pretty easy to see that the world was going to change. Not that we really understood for how long it was going to change or what the impact would really be, but it was clear by March, mid-March or something, that the economy was going to get hit. Things were going to happen. We didn't know if the world was going to end, but it was going to be a big deal, right? So that basically made me, luckily I'd actually sold like half of what I owned prior to that. So it was selling what I had left and then rethinking the whole portfolio. And actually, having to do that's not great, but having gone through it, it's the right thing to do. I think an earlier me would have been like very stubborn about it and just said, no, I'm going to stick with it. Whereas like, luckily I was open-minded enough to say like, I was wrong about how I was thinking about this, and I need to start from scratch. And I'm sure that at some point, hopefully I don't have to just start from scratch going forward. But at the same time, that's what caused me to kind of look at it more of like an evolutionary. So like going forward now, what I want to do is continue changing, but at the right pace. So, and for the right reasons, right? So looking at my thesis for what I hold, kind of reevaluating, asking like, has the business changed? Constantly trying to look out like, okay, I own Facebook, and in 5 years time, I should be asking like, okay, I own Facebook. In 5 years and 10 years, is Facebook still going to be a good thing to hold? And if the answer is, I don't think so, then I should be saying like, why do I hold it now? Even if there's like a few years left of good performance potentially. Then if the classic kind of, if you don't want to hold it for 10 years, don't hold it for 10 minutes. There's a lot of wisdom there. So hopefully going forward, I'll be a little bit more proactive about how I think about the future, so that I'm making like slow changes over time, as opposed to having to throw the whole thing out and rebuild it properly. So don't let a good crisis go to waste, I guess.
Yeah, I think that's a good way to look at it, because if you look back at the largest companies in S&P 500 or something like that 20 years ago, most of them aren't there anymore, or they're certainly not the largest. So you definitely need to be nimble at times, but also it is important to be stubborn too certain times. So it's tough to find that balance. I think that's probably the hardest thing to do.
Yeah, the thing for me is like, when I go to buy something right now, one of the things I ask is like, do I think this company is going to be the one that actually survives the next 10 years? Because businesses now on average don't really last that long. The business cycles are pretty quick. There's a lot of competition. Technology does disrupt, and so the focus on that quality, like durable moat, I think is more important than ever. And the goal should be to not sell. So
yeah, for sure.
One of the goals when you're buying is, I need to be able to not sell this. And at the same time, you should be comfortable selling when you know that that's no longer true. It's tricky.
All right. Well, that sounds good. I think if we got anything out of this, it's never sell, unless you should.
Never sell, but do sell when you have to. Yeah.
Yeah, right. Exactly. But maybe sell sometimes.
Nobody said it was going to be easy. Yeah.
Yeah, that's right. Okay. Well, thanks a lot for coming on. I always like to end where people can follow you. What's your website?
Yeah, for sure. So people can follow me on Twitter. Is probably a really good spot to find me. Cratering Value is my kind of tag I started out with, just being anonymous. but yeah, you can find me on Twitter there. My Substack, where I write all kinds of silly stuff, and hopefully people enjoy it. It's called Margarine of Safety, which is a really bad pun for margin of safety. So yeah, they can find me
Sounds
there.
good. Okay. Well, thanks for coming
Thanks again,
on.
Joe.
Appreciate it.
Yeah, thanks for having me. It was a pleasure.
Yep.
Joe is not a financial advisor and may have interest in the stocks discussed on the show, so do not take any information included within this podcast as a recommendation or formal advice. Thank you.